We've got a good crew here tonight. Thanks everyone for joining us on this evening of Game 5 of the World Series. I know we are definitely more exciting than Yankees versus Dodgers. My name's Rich Lester. I've got Chris Didier here. We'll do some intros in a minute, but we're going to spend tonight talking about the veterinary industry, the economy, and some unique things that we think are happening. And the title of the webinar is Declining Visits, Rising Valuations, and an Election. Are we at an inflection point in the veterinary market? And we actually do think we are, and we'll go through a whole bunch of stuff tonight to explain why we're at an inflection point. What we'll do tonight is I'm going to do some intros of myself. Chris will introduce himself. Then Chris is going to talk about the market and the economic outlook. I'll spend some time talking about how that economic outlook's impacting the veterinary market. We'll talk a little bit about valuations in the veterinary market. And then if you're preparing for a transaction, Chris will talk about some personal financial things. And then we'll finish up with deal structure and trends. So first, by way of introduction, my name's Rich Lester. I'm currently the CEO of Ackerman Group. I partnered with Gary Ackerman, who has moved mostly to retirement in 2024 to help run the Ackerman Group. Prior to the Ackerman Group, I was the founder and CEO of Veterinary Practice Partners, which is one of the consolidators. I started it from business plan, grew it to about 65 clinics, 1,200 people. I stepped down in 2020 from running it because we sold the business in 21 and I didn't want to keep working that hard. And after a year and a half off, I joined Gary at the Ackerman Group. And who is the Ackerman Group? Well, we're the largest broker of veterinary practices in the country. We're now moving up to Canada, which I'll talk about in a second. We sell 40 to 55 hospitals a year. We've sold over 225 practices in the last 4.5 years, 2 billion plus of transaction value. Those numbers are important if you're thinking of selling because we're doing a transaction a week, which allows us to know the market better than anyone else. We have strong relationships with all the buyers. We advocate very strongly for our sellers to get them good values. And you'll see a lot of data in this presentation, and that comes from our database of having done all these transactions over the last 5 years. We spend a lot of time analyzing our data and sharing it with folks. This is our team. We've got a handful of deal folks who lead the deals. We've got a finance team, an operations team who helps with due diligence. We've got a marketing team that helps put together webinars like this and helps us find hospitals. Gary's still a senior advisor, and we added Mike Kemp recently up in Canada as we expand. I'm not going to call it globally, but expanding throughout North America. So that's my background. I'm excited that this month or this quarter, we're having Chris Didier, who's with Bear Generational Wealth Group, join us to talk about the economy. And first, he'll give some background on himself. So welcome, Chris.
Thank you, Rich. I'm really happy to be here. So I don't really want to talk too much about myself, but I've been doing this for a long time. So I've over 30 years of experience working with families, helping successful families, primarily business owners, really get to where they want to go next, and that's usually involves what they want to do after the transition of a successful business. And so it's something that I really enjoy. I love the entrepreneurial aspects of the clients we get to work with. Usually people that have built something from nothing into something big. We started working with veterinarians about 4 years ago or so when a vet really called me out of the blue. It was in the middle of COVID and said, hey, I've heard about you, I've heard about your group, and I wonder if you would consider working with me. And I'm like, I had no idea. I mean, I always thought of veterinarians as like, we have 2 dogs and we take our dogs to the vet, and I didn't know what was going on in the space and how the veterinarians are really entrepreneurs. And And so we finally had, after many conversations, we said, okay, we'll do that. And we since then have worked with many vets and very successfully, and it's been great. People ask me, well, what's the difference between, your normal entrepreneurial client and a veterinarian client? And I'm like, they're very similar. But veterinarians tend to be super smart people. It's hard to get through to become a DVM. And so sometimes they think they can do some things by themselves where they really should bring in other advisors. Our typical entrepreneur client, a lot of them didn't even graduate from college, and so they tend to rely more on advisors. And so that's something I'd get you guys to think about, because it's really important to utilize outside expertise. And that's not just a plug for myself; it's just what we learned from experience. So a little bit about Baird. Baird, I started at Baird when we had 300 employees. Today, we're the largest privately held financial services firm in the country, with over 5,200 people around the globe. We're owners. I mean, this, like you guys, my business is the largest line item on my balance sheet. It really drives everything that I do. And one of the things that the being an owner is, we're proud of the accomplishments we've had, the accolades received. So being on Fortune's 100 best list allows us to attract a lot of great talent. And the number one macro only research firm, Strategas, that's part of Baird. It was just announced yesterday that the 8th year in a row we have the number one macro firm on Wall Street. That includes our Washington, D.C. policy expert, and we'll talk a little bit about some of the things that they say today. So as far as the markets and the economy go, I'll talk first. We do a lot of different things within our group, but I'm going to focus on financial strategy. As it relates to the market and economic outlook, we always start with the market cycle. We want to know where we are within the cycle. And that's really important, because when you're at certain points in the cycle, it dictates certain action. So for example, where we are right now, we've moved all the way up this line from optimism. We're approaching euphoria. And so that's an area where we generally look to reduce risky exposure. In fact, 9:30, we said to all of our clients, so that was the beginning of the fourth quarter, we suggested that they opportunistically look to reduce exposure to more risky assets by about 5%, or at least 5%. And the reason we're saying that is that this is the time in the market when we're likely to see corrective action. So for example, and we know this because investor enthusiasm is at those levels where it's typically followed by some sort of corrective activity. And when we look toward valuations, and we use a measure called the CAPE ratio, which is a cyclically adjusted price earnings ratio, on the next slide. So this cyclically adjusted price earnings ratio, that's the light blue line that's running through this chart. It's Robert Shiller's CAPE ratio. It's been around for a while, and there are a lot of measures of valuation. This is just one that we use. We like this because if we slice and dice the data going back a long period of time, it turns out the important lines are the red line and the gray line, because investing a new dollar of money into the S&P 500 or into risky assets above that red line it's not going to tell you what the ride is, but it's going to generate an expected return of about 4%, and that's going out 5 years and just looking back, that's about what your annualized return would be. So again, it doesn't tell you what the ride will be. You can see back in '99 there was a heck of a ride, but at the end of the 5 year period of time, you look back and you saw, well, gee, I have a 4% return. We prefer to be more aggressive in the market when it gets down towards that gray line, and that's when the return expectation goes up to about 11% or so. And so you always hear about dollar cost averaging, which is a really good thing to do, because it's allowing you to buy at these high levels, these low levels, and really not be concerned about that as you're putting money in. But if you ever end up with a pool of cash, and remember, our clients come to us and they're having a liquidity event of some sort, and so they have a pool of cash. They need to figure out when to put that into the market. So we're looking at this very carefully. And so at the edges, then we're moving up and down that a little bit in terms of the exposures that we have for them. So when we look at valuation, this is really important, because when we're looking out into the future in terms of what valuations could look like, So inflation plays a big role in that. So we just went through this really big time inflationary period, and inflation went from practically zero all the way up to almost 9%. And what we saw happen during that is we saw valuations that were really in that area when we had 0 to 4% inflation. The PE valuations were around 18. In the public markets, they were a little higher than that. Today, they've gotten kind of excessive. They're up to 24 times. And so with inflation at 2.4% in that first trough, we're definitely above where the historical range would be. But the key thing about this to note is that when we went up to that 9% inflation level, we saw valuations come down. And now it's true like for the public markets, but it's also true for the private markets. Now they don't follow in line step by step, but they do kind of like, rhyme a little bit. And so we saw when inflation was low, valuations in the private markets went up quite a bit. When inflation started to go up in the 22, 23 period of time, valuations for private investments came down, and then they started to climb back up. So where's inflation today, and could we have a second wave of inflation? And the reason we pay attention to this is because historically, and this is across economies around the globe, when you have a level of inflation that goes above 6%, 87% of the time, the data says that you will have another wave of inflation. So what we're showing you on the chart here today is the light blue line is the 12-year period 1971 to 1983. Okay. The dotted gray line is just the last 6 years. And so you can see it strikingly resembles the bump up and then the next wave of inflation that we had back in the second half of the 1970s. So that's something that we're thinking is a very real possibility, and the data says that's likely to happen. So it doesn't have to happen. It's not saying 100% of the time, but there's a high probability that that's what we're going to be looking at. And therefore, where we have valuations now that because the low inflation rate can be supported, if we get into a higher inflation rate, that's going to be a different story. So when we look at interest rates and where interest rates are and have been, this is an important chart because this is 30 years of data. This goes back to 1993. And the reason we're showing this is it's 15 years before quantitative easing started and about 15 years after. So that dotted gray line is when the Federal Reserve started its quantitative easing program. For those of you who are not familiar with that, it's essentially the Treasury prints money, lends it to the Federal Reserve, and the Federal Reserve actually goes out into the marketplace and buys bonds. And when you have a big buyer of bonds, government securities, mortgage-backed securities, interest rates go down. So for 15 years prior to QE, interest rates averaged about 5.4%. That's the 10-year. The 15 years following QE, they averaged about 2.6%. You can look at that period like right around 22. That's when QE stopped. So the Federal Reserve stopped the QE program and started rolling off the balance sheet, and we saw interest rates move up. So we would say that interest rates now are kind of in this normalization period. There's some on Wall Street that think, well, we might get back down to those lower rates of yesteryear, of the last 15 years, but without a new QE program, we really don't think that's likely. We think more what's likely is to see the range be much more like it was the 15 years before QE. And so maybe on the low end, you might see, might get close to 3% if we got into some economic turbulence, but maybe as high as 6%, more like in a range like that over the next 10 years is really what we expect. One thing to say about the yield curve before we move on from that slide is that the yield curve is something that was talked about and was the indication that we were going to be having a recession. So a lot of people on Wall Street saw an inverted yield curve and they said, well, we're going to have a recession. The thing about the inverted yield curve, and this is particularly the inversion that occurs between the 10 and the 3, and what that simply means is that 3-month rates are higher than 10-month rates. That's when you have an inversion. And it doesn't really create the concern until it normalizes. And typically, once that curve normalizes, within about 6 months is when we have a recession. So we're watching that. So as soon as you see the short rate go above the longer rate, then that's the time when you should be go below it. I mean, that's the time you should be getting concerned about the economy. So people ask about the election. We've got a lot of questions about that. And really, we all may have our individual, party of choice and, what we might favor over, someone else. That country is pretty much a 50-50 country. So, kind of a flip of a coin from that. But the stock market really doesn't care. The stock market climbs a wall of worry. And you can see from this chart here that no matter who is in charge from a political party standpoint, the market's going to do what it's going to do. And so there are some consequential things, though, coming up in 25 that whoever becomes president is going to have to deal with. And that first thing is going to be right in the very beginning of the new year. The debt ceiling expires and going to have to be dealt with. So they're going to have to extend that or do something with it, and that's going to be a challenge because of the just the debt situation. I don't if you've been watching in the papers. I mean, it's somewhat stunning that today, of all the money the federal government brings in from taxes, we are now at the level where 20% of that goes. 20%. So that's kind of crazy when you think about it. Of each dollar goes to pay the interest on our debt. And so that's going to become more and more of a challenge. And so the parties are going to have to come together to somehow resolve or come up with a solution for that. But then as you go through the year, it's going to be a consequential year for taxes too, because at the end of the year, the Tax Cut and Jobs Act expires. Rich is going to talk about that a little bit later, but there's some definite implications on that. And each party has some ideas on what to do with that. And it's really going to be coming like, do we, have tariffs and have higher costs and inflation that's driven by that, or do we have higher tax rate and that causes some sort of issues with the economy? So it's going to be a challenge no matter who's in charge, and so we expect the economy to act accordingly in the stock market as well.
Right. Thanks very much, Chris. Appreciate the economic update. I'm going to now spend a little bit of time talking about how that economy is impacting the veterinary market. Before I do that, if you're all in Zoom, towards the end of this webinar, we're going to take questions. There is a Q&A feature. If you look down where it says mute, stop video, participants chat, there should be a Q&A. And so if you have questions, type them into Q&A and we will answer them towards the end of the presentation. So I say that the veterinary industry is at an inflection point. It's because things are happening that are a little odd, and it potentially creates an opportunity. So the things that are odd and that are a bit worrying is what's on this slide, which is over the past 10 quarters or 2.5 years, there's been negative growth in invoices. So it's been negative about 2% for 22, 23. And while we don't have all the data for 24, we expect 24 to again be around down 2%. And you need to place that into historical context. So from 2011 till COVID started, our industry had unique features in that it was an industry where steady and stable growth was predictable and knowable. We had 1%, give or take, invoice growth, about 5% revenue growth for almost a decade. And during that decade, the economy was only growing 2.5%. And so our industry was growing at twice the economy. And that led to tremendous investment dollars coming in from private equity firms. And all this consolidation really began in the 2010s. And part of the underlying investment thesis was this industry has stable, predictable growth. The question now is COVID upended the stable growth and made it really rapid. But now the hangover from COVID is we're not growing so well. And the question is going to be what happens in 2025, because with 3 years of decline, some people might say that that's a cyclical change. But if we have a 4th year of decline, the questions will become, is there a fundamental change in the industry? I don't have the answers, but it's a worrisome trend that we need to think through. Despite the fact that there's fundamental issues with industry growth, it's been a very good year from a valuation perspective, and values of individual vet practices are going up, and especially at the top end of the market, meaning the $500,000 or more of EBITDA practices. And we've seen this uptick really start at the end of 23, early 24. And what we're seeing today is a continuation of that. Back in 23, the average range for purchase prices was probably 8 to 13 times. We just signed a deal at closer to 15 times EBITDA. So high quality deals are seeing real good valuation. despite what's going on with the industry. And then Chris started to talk about this. The third sort of piece that creates a potential inflection point is what's going to happen with taxes. And if you're going to sell a practice, taxes are a big question that you need to be thinking about. And so back in 2017, the Trump administration and Congress passed a tax cut bill that lowered individual rates, raised the estate tax exemption. But what they did with that bill is say, hey, we're going to have all those tax cuts just sunset or expire at the end of 2025 so that it was able to be passed. And well, it's now almost 8 years or 7 years later, and next year all these tax cuts are going to expire. And so regardless of who wins the election, there's likely going to be action in Congress to deal with these tax cuts expiring. And if the Democrats win the White House, they'll have a different perspective than if the Republicans are in the White House. And I think the risk from all of you as practice owners is there is a risk that capital gains taxes do go up in 26. I think that risk is higher if the Democrats win. And so this leads to sort of what should you be thinking if you're a practice owner and who's thinking about selling? And so we talk about and call this sort of an inflection point where what I've said over the last 4 or 5 minutes is we've got 3 years of invoice declines, and is the industry fundamentally changing or is it a cyclical change? Despite that, you've got valuations rising, and on top of that, we're seeing deals with more cash, less structure, so you have less risk on deals, and I'll talk about that more in a few minutes. And then you have this overhang of potential tax increases. And so I've worked at Ackerman for 3.5 years. We have never told clients, hey, you should time the market. We always tell clients, when you're ready, we will figure out if the market's ready. What we're telling folks today who are practice owners is, if you're thinking of selling in 25 or 26, you should do it in 25 because the market is good and strong right now, and there's a lot of risk out there over the next 24 months that we see. And Chris talked about the potential of inflation rearing its head again, et cetera, which would likely diminish valuations. So what are our predictions for the market, and where do we think it's going? Well, at a high level, the economy, inflation's now down to 2.4%, and interest rates are coming down as inflation comes down. So we had a 50 basis point drop in interest rates in September. We think there'll be another interest rate cut before year end. And valuations are starting to go up with both the rate declines as well as things that are unique to the market. The other thing that's driving valuations up besides the interest rate cuts is what's happening with the larger consolidators. And there's something called a recapitalization, which is when a consolidator or a buyer of veterinary practices sells from one investor to another. And that market, when interest rates were high in 22, 23, and most of 24, was essentially dormant. There were no real transactions. Before year end, we expect Southern Vet Partners and Mission Vet Partners to merge, and they're getting a capital infusion from Silver Lake, another private equity firm. And so that's going to be the first large recap in probably 2.5 years. And we think that that will likely start a wave of additional recaps. And that's really good for the individual practice owner who's looking to sell. And that's what's creating a lot of buying activity. As groups go to market to sell themselves, they want to show the new investors that, hey, we have a pipeline of acquisitions and we can grow through acquisitions. So groups are getting more active. And we're seeing for our better practices, 10 plus bids for practices that are sitting in really good markets with a lot of EBITDA. We're still seeing 3-4 bids for smaller practices in okay markets. So there's a lot of appetite in the market for acquisitions. And the top practices are seeing valuations go up. The $200,000 to $300,000 of EBITDA practices still seeing buyers. They're just not seeing as many, and they're seeing similar price points to what we saw 6 and 12 and 18 months ago. From a seller perspective, we saw in 2022 and 23, we saw a lot of the better practices waiting, and they missed this bubble in 21, and so they didn't want to rush into things. But now that the market sort of stabilized and is starting to see a small uptick, we are seeing and we are bringing more A practices or over $500,000 of EBITDA practices to market. So that's our view of the market. Now I'm going to spend a few minutes explaining what EBITDA is, how practices are valued, and then Chris is going to talk for a couple of minutes about when you're thinking of selling, financially speaking, how do you prepare yourself personally for that sale? And so when we talk about practice valuation, I like to talk about both an art and a science. And so when I talk about a science, I mean there's a formula for how practices are valued, and that formula is pretty scientific. It's pretty simple. It's trailing 12 months normalized EBITDA, which is a mouthful, but I'll explain what that means, times a multiple, and that gets you your value. So it's two numbers multiplied together gets you a valuation. So figuring out your normalized EBITDA, which is earnings before interest, taxes, depreciation, and amortization, another financial mouthful, it's essentially the cash flow that your practice generates. Figuring out that number is actually relatively scientific. If we're working with you, we'll gather a lot of data, we'll scour your financials, we'll add back any personal stuff that some groups, not everyone, run through the business, your family that's on the payroll, your car expenses, your accountant, you're a lawyer. There's certain add backs that we know that the corporate buyers will allow, and we figure out what your EBITDA is. And that's one piece of the valuation formula. The biggest mistake we see, what we call the DIY or do-it-yourself sellers, when they don't have an advisor or a broker, their biggest mistake is they give their financials to a couple of buyers and they let the buyers calculate the EBITDA. That's like the fox guarding the hen house. Like, is the buyer going to actually scour your P&L for all the add backs? Are they going to give you credit for everything if you're not asking? It's a really important, I think, if you're going to try to maximize what you get, is to really understand what your profit level is, and you go to the buyers with what the practice EBITDA or profit is. So that's one piece of the formula, the normalized EBITDA. The second piece of the formula is the multiple. And I have said today's market, the range of multiples is between 8 and 14 times EBITDA. And the question I always get asked is, who gets 8 times, who gets 10 times, who gets 14 times EBITDA? What this chart is trying to do is show down the left side, what are the practice characteristics that the corporate groups will look at. And then based on those characteristics, do you get a below market and a market or an above market multiple? And so I'll take a few examples. Geography and demographics do matter. If you're in a small town in rural Iowa, you're going to get a lower multiple than if you're in a fast-growing suburb of Atlanta or Phoenix. So geography matters. If you're in a lower income demographic versus a higher income demographic, you're going to get a lower multiple in a modest income area, because if there is a recession, it will impact spend on veterinary care more than if you're sitting in a high income demographic. And so there's a variety of factors, and very few practices show up in every above market multiple measure. And some practices have some things about them that maybe put them below market, some have above market. This is why, and then the buyers will put different weightings on these characteristics. And so it's why we encourage everyone to run a process where they get lots of interested parties, because figuring out what the right multiple is really important. And the more bidders you have, the more likely you'll find the one who believes your practice is worth more than everybody else. And so, as we said, there's an art and a science to valuation. The science is the formula. The art is figuring out the multiple. There's a couple of other things that are really important that impact value. One that was on that chart is your physical plant. If you have space to grow and you don't need to expand, that will help your valuation. if you're in a space and like you're crammed and there's no extra room, a buyer's going to sit there and say, hey, we've got to spend a lot of money to expand the facility or move the facility. I'm going to decrease the value by the cost of moving or expansion. So physical plant matters, your lab contract matters, and how long you have remaining. The less time remaining on your lab contract, the better. And the other one I want to highlight is if your non-DVM labor, if your staff costs are high or out of range, buyers don't want to fix that. They don't want to come in, buy a practice, and start cutting heads. And so it's harder for them to do that than for you as the owner to fix that problem. So when we see practices with high non-DVM labor, we try to work with them before the sale to figure out solutions to that. So this is how companies will value your practice. Now, Chris is going to take a more personal finance view of the sale process. So Chris, back to you.
Yeah, for anybody contemplating selling a business of any kind, I mean, whether it's you think it might be next year, the year after, or even 5 or 6 years from now, the first thing you need to do is sort of develop, and what we do for our clients is to figure out how much they need to sell it for. I mean, what do you need? What's the minimum amount you need to meet your lifestyle goal? You have a long time that you have to be projecting forward on that. What we do is we build what we call a roadmap. And remember, our whole objective is to help our clients get to where they want to go next. So a roadmap is super helpful for that. And so we model that out like using a lot of sophisticated analysis, really a sophisticated cash flow analysis that considers tax and a lot of variables. So it's variable over time. And so we get this probability, a distribution probability that we're trying to squeeze down to see, well, what is the odds of success of any given plan? I'm showing you just a graph here because it's kind of an interesting thing, because we see this sometimes. This is somebody with a really significant spend. They were going to get after-tax proceeds, significant after-tax proceeds of their business, but it came out with only a 50% chance of success. So there's a long-term horizon. So when 2024 all the way out to 2054, so 30-year horizon, and that little line there, that little arrow, is something that we never want to see. That's a bust. That basically is a plan that is not going to really test test out over time, or stand the test of time rather. And so what we would tell somebody in that particular situation is really you need to do some things to impact the value of your business. So get the business up to where it can be sold at a higher value, or plan on reducing your spend out in the future. And so you have to kind of have that planning capability. What we really want to see from a planning standpoint is individuals are going to have kind of wealth that is going to outlive them. And if you've built a successful business and you're going to have wealth that might outlive you, that's another planning situation. Because on the next slide, you'll see that there's really only 4 places that you can go with wealth that will outlive you. And so again, this is that upward sloping graph. Now you're never going to exhaust all the assets. And so we'll tell people this. I mean, there's money can go to government, money can go to your heirs, it can go to charity. You can spend more in your lifetime. We often tell people that like, hey, you worked hard to get to where you're at. You should enjoy the fruits of your labor. So maybe, spend more money during your time. I've been told I'm one of the few advisors that actually tell people to spend more money, but I do believe that. I think you only have so many hours here on this earth, and so you need to look at that wisely. These sometimes are really hard things to think about, though. So we often tell people, try to think about what you don't want, the things you don't want. I don't want to give money to my kids because I don't want to run. I don't want to pay taxes. I don't want to do this. So that tends to be an easier way to answer that question. It requires a different mindset when you start thinking about this, because you have right now a business that's driving everything. Business drives all of your financials. Unless you've built a huge portfolio outside of that, your business is still a big part of that. And from that standpoint, you're dependent on your business to produce income and pay salary plus distributions to you. You have a tax rate somewhere 30 to 50%, not very illiquid, but you can control it. You come in every day. You can decide the success or the amount of success that you'll have. Valuation, you never really have a valuation. Things kind of go up and down, and you're not really paying attention to that. That's a mindset thing that changes drastically. That you have to think about before you undertake something like this and go to a financial portfolio. Because when you have a financial portfolio driving your portfolio, it sort of changes quite a few things. One, you're going to come up with a monthly portfolio distribution to supplement your income. And that's a very important thing to figure out what that's going to look like, what the composition of that's going to be. But one thing I can tell you is that from a financial portfolio, your tax rate is going to change. So effective tax rate can drop like to 15 to 30%. And that makes a big difference in terms of the amount of money that you're going to need, because the tax rate definitely comes down. Liquidity is great because you've got liquidity on a daily basis. The problem is that you get not as much control, and so we've even experienced this. We've experienced it with all our clients, but just recently with some veterinary clients that sold businesses, and that's kind of an issue that they can't really impact what's going on in the market. And from a valuation standpoint, that's on daily. Remember, I showed you that market cycle chart with euphoria and capitulation. We had one that comes to mind, a veterinary client who sold his business at a very high valuation back in 21. We hadn't even put the money into the financial portfolio yet. And remember, we had that big 20% decline over the course of 22 into 23. And he called me one day. He goes, "Hey, Chris, I think I'm capitulating." I'm like, "We haven't even started yet." So that's the behavioral part of this that changes, because how do you get control? And so I encourage you to, well in advance of any sort of transaction, connect with an advisor. If you reach out to us, my email again is cdidier@rwbaird.com. I think it was at the beginning of the presentation. So cdidier@rwbaird.com. We'll be happy to put together a draft roadmap for you. We do this on a regular basis for all of our potential veterinary clients, and so we're happy to do that. No engagement required.
All right. Well, thanks, Chris. I'm going to wrap over the next couple of minutes and talk a little bit about deal structure and some trends, and then we'll go to questions. So if you have questions, start putting them into the Q&A box. So what we're starting to see from a deal trend standpoint is a couple of things. One, relative to 2021, buyers are way more discerning. And what that means is the level of due diligence, the level of detail that they go and look at your practice is much greater today than it was back in 20 and 21 during COVID and when the market was really frothy. But the good trend has been over the last 6 to 9 months is we're seeing a lot more cash and less structure in each deal. And what does structure means? Structure is basically anything other than cash at close is considered structure. And that structure is meant to, one, minimize how much cash the buyers put out, and two, it's put in place to align incentives. So you may get equity in the parent company. You may do a joint venture with a buyer and your hospital and still own a piece of your hospital. You may have earnouts, which are upside based on performance of the practice after close. All of those things buyers use to de-risk a transaction. And what we're seeing in 24 is deals getting simpler and more cash. And that's because, one, interest rates have started to come down. Two, deals are getting a little bit more competitive as buyer activity has picked up, and we're able to negotiate better terms and more cash. And I'll show a slide on that in a minute. The other important trend, which has been around now 2 or 3 years, is there's a vet shortage, and you and your associates are really important. And so in retention incentives for non-selling doctors are basically in every deal we see. And so some money going to your associates as incentive to stick around for a period. And then your employment contract as a seller is likely going to be longer than it might have been in 2019 or 20, because you're harder to replace, especially if you as the owner are a big producer. I've already mentioned that there's strong demand for the best practices. And then the final sort of thing that we're seeing is it's an important market piece, which is the number of buyers in this market is very large. There's a lot of entrants and a lot of players, but the players who are aggressive change over time. So the most aggressive buyers in 20 and 21, many of them are fixing their businesses and have slowed growth. and new buyers have emerged who are buying practices. And I'll show a slide on this as well in a minute to highlight how we see the buyer market changing. So this is the cash slide. So this year, the blue bars are 2022, orange bars are 23, and purple is 24. So 75% of the deals that we've done this year have had at least 70% of the proceeds paid in cash at closing. And that's double basically what we saw in 2022. Only 37% of the transactions had 70% cash at close. And so the amount of cash being paid upfront is going up. That's a really good thing for buyers who don't want to take, I'm sorry, for sellers who want more certainty and less risk. And then the other point about who are the buyers, this is a little bit of a hard chart to understand, but I'll explain it. The blue, the total bar is the number of buyers we worked with in a given year. So in 2023, we worked with 16 different buyers on our 40 plus transactions. This year, we've closed a little over 30 deals so far, and we have 9 different buyers. What the blue bar is the number of new buyers who've never worked with us before. And what was surprising to us and really good for the market is you see that in 21 and 22, there were only 2 new buyers that we worked with. But last year we worked with 7 new buyers. This year we've already worked with 3, and we'll probably close 1 more deal this year with another new buyer. And that means new players are entering the market and starting to have activity. And you may or may not know who those buyers are. And so it's really important to have an advisor helping you who knows the market and knows who's buying and who's not buying, because that has changed over time. And we're seeing it, especially over the last 12 to 24 months, that there's been a cycling of certain aggressive buyers have slowed and new buyers are being more aggressive. So in summary, I'm going to give a couple of quick points. Chris talked about the economy, that there's a risk of a rebound of inflation. We've seen interest rates start to decline. We haven't talked about the concept of a soft landing too much, but the press has. The idea is that the Fed's lowering interest rates, and hopefully that will happen without a recession. And so far, so good on that front. And there's still some risk of a recession for sure. And then the 2024 election is going to impact perception of both the economy as well as the public policy that the Democrats or the Republicans implement post-election will impact the economy. What we've seen in the veterinary market is invoice growth. We really need to see it revert back to pre-COVID norms. It hasn't happened. We've had 3 straight years of invoice decline, which I personally find worrisome. But despite that fact, valuations have gone up and buyers are being less stingy with cash and offering more cash, and they're paying more money right now despite the negative trends in the industry. And then finally, we talked about valuations, and it's an art, it's an art and a science, and getting advice as to what your practice is likely worth before you go to market is a really valuable thing. So that's all we've got from a presentation standpoint. Hopefully we were incrementally more interesting than the World Series. We will now take some questions from folks. If you can, I think I'll stop sharing my screen so you can actually see our faces a little bit. If you have questions, if you go again at the bottom of your Zoom thing, there's a video thing, there's a mute thing, and then there's a Q&A box. And if you have questions, we're happy to answer them. Someone asked, can we get a copy of these notes? It's an anonymous attendee. If you want to get a copy, just please email me. We do post this on our website, so you can watch it over and over again and see the content. And we will also send out a video link to it after the webinar's over, tomorrow morning sometime. So that's my answer to that question. Any other questions, or did we explain what's going on in the world super clearly that you guys have all the answers that you need? Or should I ask Chris some questions?
I was going to ask you a question, actually, Rich. So, how are you thinking about, or how should a veterinarian think about the real estate that they might own as part of the value that they're going to get from their practice?
So I'm going to answer Chris's question, then I'm going to go to some of the questions that are popping up. So the real estate's an important piece. So we say about 60 to 70% of our practices that we sell, the doctors own the real estate. What we advise our doctors is, one, as part of the sale process, we're going to help you get a really good lease so that then we create optionality with your building. And depending on what your plans are, personally and financially, you want to either have the option of selling the real estate, contributing the real estate to a REIT, or holding it for the cycle of the lease and then some. And that decision is something we walk through, and the options with every practice owner, what their options are. We never suggest that they sell the real estate simultaneous with the deal. It's just too much to do two transactions at once. But soon after you close on the sale of the practice is likely the time that you should start thinking about whether you want to sell the real estate or not and what you want to do. So, all right, a couple of other questions. What is the normal incentivization for retaining associate DVMs? So normal is in the eye of the beholder, but I'd say that the range, and I'm going to give you the outsized range, is as low as $25,000 to as high as $250,000. And you might say, well, who's giving $250,000 to an associate? Well, no one's giving that much money at closing to an associate. That $250,000 might be paid over 3 or 4 years, and it's typically for an associate producing $1 million, $1.25 million of revenue at a general practice. If an associate's producing $600,000-$700,000, sort of a normal amount, that retention incentive is usually between $60,000 and $120,000. And so the incentive is really how important is that associate to the revenue and the practice value. And depending on that situation, the dollar amount makes, can or can't make sense. And the question that you need to ask yourself is, what is the value of my practice if that associate leaves and I can't replace them for a while? And when you place it in those contexts, the amounts that are given to associates usually feel somewhat reasonable. Someone else wants a copy of the webinar. Please just shoot me an email after the call, and we'll figure that out. Someone's asking, what is our current fee structure for selling a practice? And I'm not going to go into it in too much detail. I'm going to just give you a couple of things. One is we take complete alignment of incentives with our sellers and our clients. So we don't get paid until you get paid. So we do all of our work assuming a deal will close, and when it closes, we get paid. If a deal gets pulled at the last minute, or we do a lot of work and no one closes, we don't get paid a penny. We're not like lawyers who get paid on an hourly basis. And then our fee is a percentage of the transaction value that ranges from 4% to 8%, depending on the size of the practice. Larger the practice, the smaller the percentage. And the other unique thing about our fee structure is we only get paid when you get paid, meaning if 25% of your compensation or your purchase price is deferred over time, we defer our fees until you get paid. And so, for example, SVP and MVP are merging, and we have a lot of clients who are going to see liquidity and get cash in their SVP and MVP stock, and we're going to make some fees now because we deferred those fees at closing. All right, next question. What is the evaluation done on boarding and grooming services that are offered? It's a really good question. So boarding and grooming on a standalone basis tend to trade at 5 to 7 times EBITDA, at a much lower EBITDA level than a veterinary practice. And that's because the stickiness of your customers is less sticky. I mean, the ability to go to a different boarding and the recurring revenue nature of it is not as strong as at a veterinary practice. If you've got a veterinary practice that's doing 90% veterinary services and 10% boarding and grooming, the boarding and grooming profits are likely going to get the same multiple as the veterinary multiple. If your boarding and grooming revenues is over 20% of your total revenue, then typically buyers start to say, hey, that's a lot of revenue, and I'm going to start discounting the multiple a little bit because I'm going to segregate out the veterinary revenue that might get the veterinary profits might get a 13 multiple, but I'm going to put the boarding and grooming profits at a 6 multiple, and I'll take a weighted average. So if you're less than 10%, no one's going to sort of piece it apart. If it's over 20%, people will piece it apart. So hopefully that's a helpful answer. Next question. If I'm interested in selling in about 2 years with the presumption of having to work for the buyer for 2 to 3 years at minimum, when would be a good time to start the process? So I think what you need to do is start with, when do you want the optionality to retire? And so from the start of your sale process, it's going to be 6 to 8 months to close. And then if you're a good producer, you got to assume that you're going to have a 3-year period to work for the buyer. So if you want to retire or have the optionality to retire in 2032, you have time to wait for starting the process. But if you want the optionality to retire in 2027 or 2028, I would suggest you start the process pretty soon. Next question. What is my email? rlester@ackerman-group.com. I'm going to probably go back to the first slide and show that at some point, but that was a really good question. Let me get the Q&A back up. We started a new practice in California. The HHI in South, the economy is good in California. Growth was really good until summer, and then it stalled. We're seeing flat revenue over the last 3 months. It's 2 DVM startup. Is it a seasonal thing? Is it the economy, elections, or a combination of all of the above? I think that the answer is, it's really hard to tell about a specific situation right now. I would say email me and I can spend a little time with you on the phone and we can talk through what you're doing and what you're not doing. It is hard to really fully understand what's going on with a practice, especially in startup. And what I'll tell people is, when you start a practice from scratch, there's usually some real growth at the beginning, and then there's some plateaus, and then it starts to grow again. And some of that's seasonal, some of that's based on your clients and when they're coming. And so it is, don't expect a straight line in growth every single month. It just doesn't happen. But it does happen over time. And so the person who started this new practice, feel free to email me, and we will chat and we'll talk. And there we go. In the chat box, we've got my email and Chris's email.
Rich, just a quick comment about that, because so something that might be worth them thinking about is that, so about that time back in the summer is when we started to notice a big difference between the, if you look at the economic distribution of income earners, between the upper half of income earners and the bottom half of the income earners. So at the upper half, everything's still fine and continues to be fine today, but the bottom half, so you started seeing companies like, Kohl's, Macy's, even Target and Amazon to a certain degree. And then Starbucks came out and said that they saw some softness in this last quarter. So they were all talking about the bottom half of the income distribution, and saying that those folks are starting to struggle a little bit and cut back some of the discretionary purchases they might make. And that may mean that, that somebody's going to take their pet to the veterinarian less than they otherwise would.
Yep. Although I think you're totally right. This practice that this person's talking about is in Orange County, California, where income is generally pretty high, but not consistently. But I think consumer spending on the bottom half isn't definitely an issue. So one final question, unless others are typing stuff in. So someone says they've changed their software to a cloud-based system. Will that affect the reports we need for a sale next year? So my answer is make sure you have access to your old system for a couple of years post your change. You'll have to, most everyone does retain access to their data in their prior system. And if you haven't, pay the fees so that you can retain access to the data from your old system. And then you'll just run reports from two different systems. Many people are switching to new cloud-based systems. I would say be very careful. Certain cloud-based systems have really good reporting. Others have really crappy and bad reporting, pardon my French. So just make sure that when you're transitioning to a cloud-based system, which, like I said, many folks are starting to do, that you have the robust reporting that you need. There's one or two systems out there that have really, really spotty reporting, and it can take hours to run reports if you're running them for a 6-month time frame, and that should just not happen. So if you're transitioning to a new system and want some quick advice on what our experience has been, feel free again to email us. And we definitely have opinions on, having gathered data from every practice management system on the market, as to what has good data and what doesn't, both the legacy systems and the newer systems. All right, we're at 8:57, so we're 3 minutes from 9 o'clock. So I think Chris, we've successfully done this in just under an hour. I don't have a baseball score yet, but I will probably go watch the rest of the game soon. Thanks everyone for attending and spending your Wednesday evening with us. We appreciate it. If you have questions for either of us, email, call, we're happy to help, and look forward to seeing what next week brings with the election. Hopefully it will go smoothly and peacefully. And I think 2025 is going to be an exciting year for everyone. So be good, everybody. Thank you.